PantheonAI presents Service Sector Contracts, Ethereum Rallies, Trump Tax Plan Raises Debt Concerns. Welcome to the PAI Morning Briefing, everyone. I'm your host from PantheonAI, and it's June 4th, 2025. Good morning. I hope you're ready to really dig deep into the markets today, explore some of the latest trends, and just get a comprehensive view of what's really shaking up the financial world.
Absolutely, Jose. It feels like there's always so much happening. Where should we even start today? Maybe a quick glance at the major indices?
That's a great idea. Let's kick things off with a quick market overview. The S&P 500 is sitting at roughly 5,971.689, reflecting a modest dip of about negative 0.121%. Not a huge move, but still in the red.
Right, and it's a similar story for the Dow Jones, isn't it? Trading at approximately 42,518.488, down around negative 0.13%. So we're seeing this consistent, slight downward pressure across the board.
Exactly. And over on the NASDAQ, prices are close to 19,416.976, marking a dip of nearly negative 0.92%. The Russell 2000 is trailing at roughly 2,097.813, showing a fall of negative 0.26%. So, broadly speaking, a bit of a pullback today.
It's interesting to see that widespread, albeit modest, decline. But, shifting gears to digital assets, there's a bit of a different picture forming, isn't there? Bitcoin is holding at about 105,155.13, with a slight decline of negative 0.27%, which kind of mirrors the traditional markets.
It does, but here's the fascinating part: Ethereum. It's the notable exception, with a robust gain of about positive 2.24%, trading around 2,652.665. That's a pretty strong move against the current, wouldn't you say?
Absolutely. That divergence is really prompting us to ask, what exactly is propelling Ethereum's momentum, while other indices and even Bitcoin are showing signs of wear? It's a big question for crypto investors right now.
It really is. And moving beyond just these surface numbers, let's dive into some of the major market trends. Today's discussions are really highlighting some powerful, and frankly, perhaps unsettling economic signals.
Yeah, like the U.S. service sector. News today tells us it contracted in May for the first time in nearly a year. That's a pretty significant data point, especially since it's largely attributed to ongoing trade disputes impacting business hiring and market confidence.
It's a stark reminder, isn't it, that global trade tensions have profound and immediate repercussions on the broader economy, especially within the service sector, which has historically been such a pillar of strength for the United States. That's a big deal.
And then you add the juxtaposition of mixed job data. Bank of America is forecasting a modest rise in non-farm payrolls for May, projecting an increase of around 150,000 jobs. Sounds good on the surface, but the market sentiment seems really tinged with uncertainty.
Exactly. Investors are wondering if this isolated sign of growth can really offset the worries emerging from the weak ADP jobs data. Jim Cramer, the market commentator, called it disturbing, remember? He warned that stocks coming into earnings with too much heat could face significant volatility if that jobs data doesn't clear up some underlying economic headwinds.
Cramer's not one to mince words, so that disturbing comment definitely caught my attention. And then there's the political and fiscal dimension we have to consider. A Congress budget watchdog highlighted that the Trump-backed tax bill could add a staggering $2.4 trillion to the national debt.
Wow. That political debate isn't new, but it's resurfaced with renewed intensity. Lawmakers, industry commentators, even unconventional voices like Elon Musk are weighing in. With spending concerns and tax policies in the spotlight, the potential for policy-induced market volatility is very real. Investors really need to stay nimble and well-informed.
It's a lot to process. This mix of service sector contraction, mixed job data, and this huge fiscal policy debate, it really gives rise to a rather interesting market sentiment today. Some are seeing it as an opportunity. Every crisis has seeds of opportunity, while others are definitely adopting a more cautious stance.
I find it particularly intriguing how these different elements interact, impacting everything from large-cap indices to even niche sectors like cryptocurrencies. Let's expand on some of these critical stories making headlines today, shall we?
Please do. First up, that contraction of the service side of the U.S. economy. It's causing ripples across the board. When you think about it, our service sector, everything from retail to professional services, it's like the circulatory system of the economy. When it slows down, the entire body feels the impact.
That's a great analogy. And this downturn is a direct reflection of those trade wars that have been simmering for months now, freezing hiring and causing widespread uncertainty among businesses. For investors, this really raises an important question. How sustainable is this seemingly stalled growth, and what long-term adjustments might businesses need to make?
It's a critical question that requires deep introspection, not just into the numbers, but also the underlying human element of our economy, wouldn't you say? And then there's that commentary from Jim Cramer regarding the ADP jobs data. When a seasoned commentator like him calls the data disturbing, you know the stakes are high.
He's not wrong. His concern centers on the notion that companies might be coming into the earnings season with overly optimistic expectations. If the actual job data doesn't meet those expectations, we could see sharper corrections in stock prices. This brings to mind the broader debate. Is the current market exuberance really backed by fundamental strength, or is it merely a bubble waiting to be pricked?
That's the million-dollar question, isn't it? Are companies truly robust enough to weather a tightening labor market, or are we witnessing inflated confidence that could lead to volatility once earnings start rolling in? It's a debate that continues to stir in boardrooms and trading floors alike.
Definitely. Another important headline to discuss comes from Bank of America, which is forecasting a modest 150,000 increase in non-farm payrolls for May. While this might seem like positive news in isolation, it carries with it some nuanced implications.
Right. The forecast, when compared with broader economic indicators, suggests we might be in a phase of gradual recovery rather than a rapid turnaround. And BOA actually cautions about downside risks given the current trade-related hiring volatility. So while the numbers hint at growth, they also come with a built-in level of uncertainty, which could catch the market off guard.
The message for investors here is clear. Remain cautious and diligent, especially as geopolitical tensions and trade policy uncertainties continue to loom large. Now, switching gears, we have that particularly contentious fiscal policy issue in the mix.
The heated debate over the Trump tax bill. That potential $2.4 trillion addition to the national debt, it's captured headlines and is really stirring discussions on Capitol Hill. This isn't just a debate over numbers on a balance sheet, is it?
Not at all. It's about the long-term fiscal health of the country, investor confidence, and even global economic stability. With such a significant addition to the debt ceiling, questions naturally arise. How will this affect the credit rating of the United States? And what ripple effects might this have on international investment flows?
For many investors, these aren't just abstract policy debates. They directly impact borrowing costs, market sentiment, and ultimately, capital markets across the globe. Given these challenges and opportunities, our analysis naturally extends to a detailed sector review.
Let's start with the technology sector. Tech companies have long been the poster children for growth and innovation. But with the current economic backdrop, they're facing pressures that are anything but straightforward. Despite the perennial optimism in tech, we're starting to see warning signs.
Yeah, with cautious consumer spending and potential regulatory headwinds, that's a big one, influenced by comments from lawmakers over issues like data privacy and antitrust concerns. Tech stocks might not see the explosive growth some investors were expecting last year. But on the flip side, some tech firms are incredibly resilient.
They are. They continue to deliver innovation that drives long-term value. So, while there might be short-term volatility, many analysts, including those at PantheonAI, believe this is merely a period of recalibration rather than a full-blown tech bubble burst. What about energy?
The energy sector often serves as a barometer for global economic activity. Price fluctuations in oil and natural gas can have a ripple effect across multiple industries, and recent trade tensions have definitely contributed to erratic price movements. On one hand, trade war uncertainties are causing supply chain disruptions, prompting energy companies to brace for temporary downturns.
But on the other hand, the complex geopolitical environment might also push certain energy stocks higher as investors seek safe havens. Alternatively, there's a growing emphasis on renewable energy, with investments in this space rising amidst global sustainability commitments. So if you're an investor, you have to ask, is your portfolio positioned for the clean energy transition, or are you more exposed to traditional fossil fuels?
That's a crucial question right now. Now let's talk finance. With the service sector showing signs of contraction and banks navigating uncertainties in non-farm payrolls and lending, financial institutions are understandably on high alert. Many banks are reevaluating their credit risk models, considering both domestic and international factors.
And changes in interest rate policies, we all know how sensitive bond prices and loan performance are to those, mean that caution is definitely warranted. The debate over the Trump tax bill also places additional pressure on the financial sector. Increased debt levels can lead to higher interest expenses over time and may eventually impact mortgage and consumer lending activities, which are critical to the overall health of the economy.
When we broaden our lens to the global market implications, the stakes only get higher. What happens in the United States, especially with trade wars and policy debates, sends shockwaves around the world. European and Asian markets are watching closely, often reacting in tandem with American indices.
And while there's often a lag time in how international markets respond, the global financial system is just too interconnected for any country to operate in isolation. Investors across the globe are in lockstep, caring about the U.S. service sector contraction, payroll forecasts, and fiscal policy debates. These factors transform into broader themes of global supply chain resilience, cross-border capital flows, and even the behavior of emerging market currencies.
It's true. As we analyze these trends, it's crucial for investors and traders to maintain a global perspective, constantly assessing how domestic disruptions might amplify or mitigate risks abroad. And speaking of insights, you recently spoke with a colleague who's been tracking these economic trends for more than 2 decades, right?
I did. And his sentiment was that while caution is always advisable, the market has a remarkable way of absorbing shocks over time. His recommendation? Maintain a diversified portfolio. He actually chuckled when he said, if your portfolio was a family road trip, don't put all the snacks in one basket.
Haha, that's a good one, but it really drives home the point, doesn't it? Diversification across sectors and asset classes helps insulate against the unexpected. With volatility across various indicators, from equity indices to cryptocurrencies, having a well-balanced, diversified portfolio is more important than ever.
It really is. And speaking of diversification, let's revisit the cryptocurrency landscape for a moment. Bitcoin has shown that slight dip recently, while Ethereum has surged ahead. What does this mean for your digital asset strategy?
Well, some experts suggest that Ethereum's recent gains may be driven by increased activity on its blockchain, including the growing interest in decentralized finance applications. Meanwhile, Bitcoin's slight faltering could be attributed to profit-taking by investors after a period of significant gains last year. But here's a thought-provoking question for all of us. As institutional investors and regulated entities begin to take digital assets more seriously, could we be on the brink of a paradigm shift?
You mean where cryptocurrencies move from speculative investments to a recognized financial asset class? That's an exciting debate, and one that we will certainly be watching very closely. Let's take a step back and consider the broader picture for a moment.
Sure. Every market cycle has its set of challenges and opportunities. Today's headlines, from the service-side contraction to the nuanced commentary on employment numbers, are a reminder that the market is a living entity, shaped not only by cold, hard figures, but also by geopolitical realities and human behavior.
We find ourselves in a period where growth may seem slower, and uncertainty may be higher than in previous cycles. But remember, much like a roller coaster ride, every dip is often followed by a climb. The key is to remain vigilant, diversified, and always ready to adapt to new information.
That's a great point. And that leads us naturally into our detailed sector analysis. In the technology arena, innovation continues unabated, yet regulatory uncertainty looms large. Could the tech giants we've grown so accustomed to be challenged by emerging startups that are nimble and less encumbered by legacy issues?
Or, conversely, might we see a consolidation in the tech world as smaller players merge to compete effectively with established giants? These are questions every tech investor should be asking. On the energy front, how sustainable is the current oil price given the twin pressures of geopolitical instability and the global push towards renewable energy?
Energy markets are traditionally influenced by a mix of supply disruptions and demand cycles. With trade tensions leading to sporadic supply chain interruptions and a global emphasis on cleaner energy sources, traditional oil and gas stocks might face headwinds. Yet, for those with the foresight to pivot, renewable energy stocks could offer significant upside potential.
It's almost ironic, isn't it? While the world grapples with climate change, the very geopolitical crises that often disrupt energy supplies might accelerate the transformation towards greener alternatives. It's a classic case of a challenge turning into an opportunity.
Definitely. In the financial sector, banks are navigating a complex landscape. With interest rates likely to remain volatile and credit risks constantly in flux, financial institutions are balancing the need to maintain robust reserves with the ever-present pressure to deliver shareholder returns.
And that debate surrounding the Trump tax bill only compounds these challenges. With the potential for an additional $2.4 trillion in national debt, the financial sector may face tougher regulatory scrutiny and pressure on profit margins. Yet there's also room for optimism.
True. As the economy gradually recovers, banks that manage their risks prudently are likely to emerge stronger, with enhanced opportunities in areas like digital banking and fintech innovations. And on the global stage, every head-turning piece of news from Washington, D.C. sends reverberations overseas.
European markets, which have grown accustomed to a level of economic stability, are now bracing for potential fallout from U.S. fiscal policy. Similarly, Asian economies, long interlinked with global supply chains, are meticulously tracking these developments. The interconnected nature of global markets means that a contraction in one country could lead to a tightening in another, making political and economic coherence more critical than ever.
Investors around the world are rethinking their strategies to account for an environment where a policy decision in one nation can have far-reaching implications elsewhere. So at this point, you might be wondering, what are the key takeaways from all of this?
Good question. First, be mindful that every bit of data, from a slight dip in an index to a significant policy debate, adds up to a larger picture. This panorama demands that investors maintain a blend of caution and optimism, ensuring they're well-positioned to capitalize on opportunities while mitigating risks.
And second, with inflationary pressures and geopolitical uncertainties lurking in the background, the time-tested strategy of diversification remains more relevant than ever. And third, as exciting as emerging sectors like digital currencies and renewable energy might be, making informed decisions requires balancing risk with reward in every aspect of your portfolio.
Over the past few minutes, we've journeyed through a landscape of shrinking service sectors, mixed signals from job data, fiscal policy debates, and sector-specific challenges in tech, energy, and finance. There's no single narrative here. Rather, it's a mosaic of factors that collectively shape market dynamics.
It reminds me of a conversation I had recently with a fellow analyst who joked, "The market is a lot like a good mystery novel. Just when you think you figured it out, another clue pops up to change everything." And indeed, that is the nature of live markets.
That's so true. Before we wrap up, let's look at some thought-provoking questions. What does the contraction in the service sector truly signal for long-term consumer behavior? Should we be wary of the, quote, too hot to handle earnings scenarios that Jim Cramer warned about? Or does this market cycle present a unique window for savvy long-term investors?
And finally, how might the unfolding political debates influence not just fiscal policy, but the confidence of everyday investors and institutions alike? These are questions that don't have immediate answers, yet they underscore the importance of staying informed and engaged.
As we draw today's discussion to a close, let's quickly summarize our key takeaways. The market is displaying modest declines across major indices, with the S&P 500, Dow Jones, Nasdaq, and Russell 2000 all showing slight downward movements. Bitcoin has dipped slightly, while Ethereum is enjoying a modest gain.
The contraction in the U.S. service sector signals challenges posed by ongoing trade wars, while mixed job data and fraught fiscal policies add layers of complexity to the market outlook. In our sector analysis, technology, energy, and finance each carry unique dynamics that require investors to remain agile and diversified in their strategies.
And, globally, the ripple effects of these domestic issues are poised to affect markets far and wide. A huge shout-out goes to PantheonAI, your trusted information copilot, for continuously empowering us with timely insights and in-depth analysis that make navigating these turbulent market waters a little bit easier.
I encourage each of you to take the time to explore these topics further, ask questions, and keep an eye on emerging trends that might reshape not only your portfolio, but also the broader economic landscape.
In closing, I leave you with this. What will the market look like when we peel back the layers of these interlocking policy debates and economic indicators? How might emerging trends in technology and global trade redefine what we consider normal in the financial markets?
Let these questions simmer in your mind as you assess your own investment strategies. Remember, learning shouldn't feel like a full-time job, so take your time, digest the information, and most importantly, stay curious.
Thank you for tuning in to today's PAI Morning Briefing. I look forward to discussing more developments with you tomorrow. As always, feel free to reach out and ask questions to our AI copilot at PantheonAI. Until then, stay sharp, stay informed, and have a great day ahead.
Pantheon AI, your information copilot.
Because learning shouldn't feel like a full-time job. Take care and see you next time.